Reporting.
All right. Okay, well, looks like we're getting people joining us, Tom, but welcome to you, mate. Thanks for joining us once again, as always.
Thanks for having me, Brendan.
Yeah, and a big welcome to all our clients. Obviously, there's been a lot going on. It seems to be the same thing I say every time, but there's a lot been going on, especially in recent times. And these webinars we feel is an opportune time for Tom just to give an explanation of what's been happening, what we see is happening, and what we expect in the future, and an opportune time again for clients to ask any questions. So with that in mind, Tom, I'll hand it over to you, and away we go.
Excellent, thank you. There's a Q&A section just at the bottom. You can click and type in questions, and Brendan will monitor that and fire it back at me as we go. Please happy to answer anything along the way.
Sounds good.
Okay, here we go. So in terms of agenda, we'll have a look at portfolio performance over the year so far and longer term. We'll then have a look at what's happening in terms of the global economy, so economic growth and the all-important outlook for inflation and interest rates. Australia's literally just reported its CPI number, positive surprise versus consensus, but still elevated, and that's a topic for discussion today. The impacts that higher interest rates and inflation have had on the bond market, they've been quite pronounced, severe, if you will, and just what that means and where the opportunities may be. I'll touch on the Middle East conflict. I would say that seems to be petering out, but it's worth addressing given it has been in the headlines and remains in the headlines. We'll have a quick look at equity earnings and valuations, defensive assets. Paid to wait is a real key theme, I think, for us here now, as the yields, as a result of higher interest rates on the defensive side of the portfolio, are now very attractive in absolute terms and versus history. Another area we're doing a lot of work on is real assets, so real estate and infrastructure. These two sectors of the market have been impacted again in the short term through higher interest rates and the valuation impact, but are there opportunities emerging for a long-term investor? And then finally, how all that sort of gets summed up in our portfolio positioning. So in terms of performance, relatively good numbers in the sense of not falling as much as the market over the last sort of 1 month, 3 months, 6 months. These are to the end of October. So through the volatility, that sort of capital preservation strategy playing out well. I guess probably the big call out here is just it has been an extended period of elevated volatility in the last 2 years. If we look at something like the balanced portfolio or the growth portfolio, like you basically square slightly down over a 2-year horizon, which I appreciate maybe a bit frustrating for some, just given it starts to test all of our collective patience. But some context around the current cycle, I think, is important here. The last big bear market we had was short and sweet. It was all over in 4 weeks. It happened in March 2020, and it was due to COVID. And it was quite unusual in historical context. It was a exogenous sort of left field event that caused the market to fall a lot in a short period of time. Equally, there was an enormous response, I guess, by central banks and governments that then caused a huge boom in equity markets, global growth, and the rebound was really quick. And so our memory of that from a market perspective was pretty muted. This period is a more typical adjustment driven by higher interest rates. It tends to be what causes these extended periods of volatility in markets. It is really getting to the end of an interest rate hiking cycle. So at the end of the 90s, we saw the tech collapse, and then the subsequent ongoing bear market that went really from 2000 and bottomed in 2003. So it was quite an extended period of volatility. Similarly, the GFC, higher rates all the way through to the end of 07, start of 08, and that really didn't clear out until 2009. And similarly here, we saw the end of the zero rate policy at the end of 21. The volatility commenced sort of at the start of last year, 22, and here we are at the end of 23, still talking about it, unfortunately. I guess that, we'll show you later, we are getting closer to the end of that, and the opportunities have emerged as a result of that ongoing volatility. But when we're in this environment, the big focus for us all is really just preserving the capital, trying to generate some good income along the way, and making sure we don't get blown up by, there's lots of landmines out there, and we're really trying to avoid those. And so, pleasing to say we've done that piece. As we look forward, into the new year, we're looking for opportunities where we can hopefully start to see growth resume in portfolios. And look, the long-term context there, just around different periods. You can see FY in the sort of COVID period, generating outperformance, so preserving capital through FY20. Similarly in FY22 last year. Didn't quite keep pace last year in the financial year. One, just given our view that the cycle wasn't over, we remained a little bit cautious coming into this year, and so March was a bit of a challenge. In absolute return, in terms, still made money, just a little bit less than the benchmark. You can see again here, starting to outperform again in the current financial year as a result of maintaining that defensive stance. And it's fair to say we're not always pessimistic on the world. As I said earlier, post the COVID collapse and all the stimulus that came, we saw 6% global GDP growth, really strong equity markets, great tailwinds, great time to take risk and be invested and be overweight growth. And we were. And, you can see that through the numbers, 15% for balance, 20% for growth, 25% for high growth. That's indicative of being fully invested at that time, but that was when it was a good time to be fully invested. We're hoping to see those times resume again and sort of be able to deploy some of that cash again. But for now, as you can see, the real focus is on that preservation and managing through the current volatility.
So just to clarify, and I think this is important because it's obviously been enormous volatility, as you suggested, Tom. But if you look at the FY23, and we've underperformed our peers. So I think, again, just as a reminder for clients, can you provide an understanding of what you mean by peers? Who are we comparing from a benchmark perspective, first and foremost?
Absolutely. As every investor's got their own individual sort of risk profile and investor profile that's really trying to align, the advice and your objectives with the right investment portfolio. And diversification is the key. So what is the optimal mix of assets within that risk profile to help you achieve those goals? And within that, there's lots of different choices of growth managers, balanced funds, etc., out there right across the market. And so when we say peers, it's really looking at all of the possible opportunities or different products and funds and strategies you could invest in with that same risk profile. So it's like for like in terms of the amount of risk that's being taken, in theory. But the outcome's obviously different in terms of investment strategy. Each manager will have their own style and process, etc. And so it's the best benchmark for us to reference our diversified portfolio with the same risk. Are we generating better returns for the same risk? And over the long term, as you can see there, the answer is yes. So importantly, we want to try and do it with less risk, like less volatility, and achieve higher returns. And I guess that's sort of consistent with philosophy.
So even though we've had a positive return in the FY23, we've underperformed that peer group, and that is a result ultimately of us being a little more conservative during that time when others weren't.
Right. Yeah.
The
As we came into the end of last year, there was still a myriad of issues that we considered, it wasn't the time to be heroic and be overweight growth. And in the first quarter of this year, really the markets, they jumped a lot. China reopening, the start of the AI boom. And so we just missed a bit of that upside over that quarter. Since then, as you can see, really over the last 6 months, it's been back to sort of the volatility. And so sticking with that positioning rather than chasing it dead back then has been it was the right call, but at the time it wasn't right.
Yeah. And I think also too, I think an important part that you just touched on there, again, just for clients' understanding of how you manage a portfolio, the volatility aspect. So we've got, when you look at it, and I'm just looking at the balance as an example, the balance fund where we've got volatility 6.9 for us and our peers at 8.9, which is, can you give an explanation as to what that is telling us?
Absolutely. So volatility is just really a measure of how much the portfolio is moving around up and down around its average. And so for us at 6.9, We're 2 percentage points lower than the peer group. 2% doesn't sound like a lot, but it is, and it means a lot in terms of the journey, particularly if you're drawing income. That difference is, more income in your pocket because you're drawing from a consistently higher level within the portfolios. For context, like long-term equity market volatility, or if you just own shares, it's about 15. So you're less than half the volatility or risk of being purely invested in growth. And that's the benefit of being diversified within the portfolios.
It's a good measurement to show that the diversification that we have in the portfolio helps us smooth those returns.
That's right.
When we do have a time where things are ordinary, we don't intend to have this. We don't expect to have the same impact as to what our peers would. If we have a small period of time where the markets jump, then you might find the peers will outperform, which is what we're seeing in that FY23. But longer term,
when markets are good and we believe them to be good, we will be invested and keep. And you can see here kind of keeping pace in the really strong period. But that was when, in our view, you had strong tailwinds for investing.
Yeah.
At this end of last year, start of this, despite the fact that markets rose quickly, we still didn't think, with interest rates continuing to rise, inflation persisting, all of the issues that we've seen, Silicon Valley Bank ended up falling over in March, right? So we've seen the sort of reasons why not to chase that short-term period of upside in markets. We will get plenty of chance on the other side to reset and take on more risk, but do it when we feel like we've got those tailwinds, for us, and it's not as risky to do so.
Yeah. Okay. Thanks, Tom.
I mean, this next chart probably just highlighting, I think, some of that journey. So this is really just looking at Australian equities. That's the pink, if you will, the mauve line at the top. Has actually been this is since the end of the bull market and the start of what we call the bear or the volatile period. So the end of 21, as interest rates came off zero, the volatility really commenced in markets. And so Aussie equities actually largely due to early sort of outperformance last year because commodity prices were so strong through the early part of 22 on the back of the Ukraine-Russia war, helped prop up our market. And so, total return terms, including dividends, has sort of largely held ground over the journey. Global equities, the red line, you can see incredibly volatile, much bigger downside. At one stage in September last year, down over 20%, has bounced back a little bit, but does remain volatile, is still sort of 10% below its highs. The blue bar is really the big surprise. So-called defensive asset in global bonds is down still over 15%. And so we'll talk a little bit more about that. We haven't had a lot of exposure to that part of the portfolio. But these two bars in the middle of the blue, two blue and green, if you will, that's where my colour blindness will be tested. The one, we're sort of there. We're only marginally a couple of percent behind where we were back then. The benefit of blending, the different asset classes, but then obviously just the journey. So you can see much smoother journey through what's been quite a volatile period for markets, and that's really what we're trying to achieve: hold ground while we're in this environment, and then reassert the position of the portfolio to try and then capture the next sort of bull phase in markets, which it won't be that far away, we hope.
So the capital preservation part of the investment philosophy has been the predominant part of the portfolio in recent times, effectively.
That's right.
Yeah.
So what's the outlook for growth? This is our global growth barometer. Zero is average, and so the global growth of dark blue in aggregate is still below trend and still sort of pointing down. So we're still going through a kind of slowing phase, and the impact of all the rate hikes we've seen in the last 18 months is really starting to affect the global economy and slow down activity. And we're seeing that across the board. In Australia, in particular, as a result of greater interest rate sensitivity. So the bottom right chart is actually showing household debt service ratio. The red bar at the top, Australia, you can see 17% of household income is going to service debt, and how that compares to somewhere like the UK or even the US, which is only 8 or 9%. So more elevated debt levels, more variable rate mortgages, means that we've been far more sensitive to higher rates. And then if we look at the composition of what's dragging Australia's growth down, we can see blue, the consumer, early part, yellow, housing, so the two interest rate sensitive parts or sectors of the economy in consumption and housing, dragging on growth and bringing it lower. So Australia's sort of struggling along, and we hear a fair bit about cost of living pressures. It's becoming more political, etc. So it's reflected in the numbers that we're seeing. Inflation and interest rates, the two big questions. So are we there yet, I guess? On interest rates, I'd say we're certainly pretty close. So the trajectory for inflation is going in the right direction. It's just this last leg down. If you remember last year, we were sort of looking at really quite elevated levels of headline inflation, like 9–10%. That's come down now. Core inflation is down at sort of 4 in the US, just below. We just printed 4.9 CPI number in Australia just now. It's still above the target. That's the problem. So, in Australia, we're targeting 2 to 3%, as the central bank is. In the US, we're trying to get to 2. And so whilst it's come down, it's still above target. And in that environment, the central banks can't cut rates. Now, it looks likely that we're close. That you might get one more rate hike from Australia because we've been a little bit behind the US, which is already at 5.5. We're now at 4.35, and that CPI number today will probably cause them to want to go maybe one more time in the new year. But we're pretty close to what we think is peak level of interest rates. But it's just that the expectation was for a period of time that they were sort of going to go up, control inflation, and then come back down. We've seen a lot of that pricing come out of the market. So this chart on the right is just showing the market's pricing for interest rates out over the next couple of years, and you can see it's largely flat. So we're sort of at the top of where the market expects them to be, but there's no more rate cuts priced in. So we're sort of higher for longer is the new narrative, and that's really because whilst inflation is continuing to fall its own volition, like the impact of previous rate hikes slowing economic growth, commodity prices are weakening again. They start to flow through slowly. This last leg, 9 to 4% was easy. 4 to 2 looks like it's going to take a bit longer. So they need to stick with these interest rate settings in order to keep that trajectory going in the right direction.
And this is a different. I think we saw a very similar expectation or chart forward looking last year, but it did the opposite, didn't it? I mean, we've had, we were talking last year about potentially, rates being cut. And in fact, we've only seen them continue to rise in the last few months. So, I mean, although we predict these things happening, there's just so many different aspects that can change the landscape and
That's right.
around.
And look, that was one of the key reasons why we remained more cautious. We thought the expectation that interest rates would be cut now for us was really unrealistic. We didn't think that we'd finished even the hiking cycle, let alone commence the cutting cycle. And I think it's taken time for that to flow through, but that was one of the key differences, I guess, for us versus what the expectations in market were and why we remained defensive. And I guess now we're here seeing more rate hikes and the persistence of, and now we're seeing the volatility and the slowing, that's sort of coming through.
Now, I might be colourblind too, Tom, but I'm assuming that it looks like you're saying that the US market, the Fed Reserve, is expecting cuts in maybe the second quarter of next year. Have I got that right?
That's late. So late next year, there's some moderate pricing of cuts, a couple in, but pretty moderate relative to where they were, if that makes sense. Yeah. Europe's always in recession, it seems, so they're always sloping down.
Yeah,
that's the grey bar at the bottom. Yeah. But it's not a lot in the market. Canada flat, Australia flat. New Zealand, etc. So we'll see.
Positive in the sense for clients who are obviously drawing on an income and relying on better rates. Right. Higher for longer is a positive outcome, at least from the defensive portion of the portfolio.
We've normalised interest rates. It's sort of like they're not higher than they should be. They're just they're back to normal levels, and we may look back in 10 years' time reflecting on this period, but really in history, the 10 years post the financial crisis may look like the aberration, like zero rates, and in some cases negative interest rates in Europe and Japan are just like they're the anomaly. A normal environment is actually a positive interest rate, and that's sort of what we've come back to. Good for retirees for sure. Good for all of us building diversified portfolios as well. The bear market in bonds. So higher long-term interest rates equals lower bond prices. So that's the first thing I'll say. So as the price goes up, as the interest rates go up, the price falls and vice versa. And so after a long period of falling interest rates and therefore bond prices going up, we've had the reverse occur over the last year. And because of how low interest rates got, the reversal has been quite painful for the bond market, particularly versus history. So we're looking here at the peak to trough decline in bonds and equities in Australia going back to 1980. So the yellow line is the peak to trough price fall in the Australian 10-year government bond, so the risk-free asset in Australia. And you can see here, the previous episode, the worst one was so 1994, there was a big bond market sell-off. And so the price fell 20%. Well, this time we're down 25%. So it is a record in Australia. Blue line is peak to trough decline in equity markets. So you can see sort of close to 50% in the GFC. But I think what's worth noting is generally most of the time bonds are pretty stable. They're considered a defensive asset. And it's really quite unusual to see a drawdown of this magnitude in the bond market. It's more like equities. And so that's been significant and something that we've had to actively manage around on the defensive side of the portfolio, which we'll talk to a little bit more. But it's also bringing out opportunities in defensive assets and within bonds themselves now because of the magnitude of the fall that they've experienced.
So to clarify, Tom, just going back to that slide, when we're seeing markets not perform well, we'll typically find that the bond markets or those fixed interest investments will act as a defensive portion of the portfolio to keep the portfolio steady. But that's exactly what hasn't happened this time around, which I think at the time we talked about last time, it hadn't happened for over 40 years. So
that's right.
In addition to volatile share markets, we've also seen this downward trend in regards to bond markets, which has also had an impact on performance of the portfolio.
It has. It is also why we held a lot of cash last year. So, I think there was some questions over time from yourself and your clients around why do we hold so much cash? Well, cash is cash. You get your dollar's a dollar. Albeit the interest rates last year weren't attractive. What we were concerned about is the fact that the bonds could fall a lot in value, and within the defensive part of the portfolio, we didn't want to own them or didn't want to own a lot of them. We favoured cash, and so cash holdings for an extended period, really through to probably the first half of this year, were very elevated, and it's really only been now we've seen this sell-off happen and yields improve in the other defensive parts of the portfolio, which we'll talk to a little bit in a moment, that we've really now been redeploying that cash into bonds and credit where we can get better yield, having cash done its job of preserving capital, I guess.
So there's really nowhere to hide during that time, hence why we're overweight cash, which we knew at least protected the capital.
That's right.
And we're at a point now, just again for clarity's sake, we're at a point now where these assets are becoming, bond assets as example, are becoming more attractive at these levels.
Absolutely.
Yeah.
So just to kind of show that journey, I guess, in terms of changes and how we thought about managing the bonds within the portfolio, the dark blue is the Australian 10-year government bond yield. So you can see back in 20, we were below 1%. It's extraordinarily low for a 10-year interest rate to be under 1%. The Australian government should have borrowed more back then at 1.
To clarify, are you saying that what was a 10-year bond, if you bought it back in June 2020, you would have received less than 1%?
That's right.
Yeah. Gives you an indication of what rates are available, right?
So we basically didn't have any. And then when they sold off initially to 2, you can see here we got up to about 6%. This is within the 50. So this blue line is basically showing the exposure of the portfolio. Very marginal here, you're sort of like 2 or 3%. And then as they started to sell off, we progressively averaged back in at higher yields. So, definitely didn't pick the top, but relative to where we sit today, and if the 50 portfolio, the neutral position is 50% growth, so shares and the like, and 50% in defensive assets such as bonds. So to only have 3 or 4% of 50% in this asset class is really a low allocation. The rest obviously had to be a lot of cash, hence the previous comments. And then as the bonds have started to, bond yields have risen, and remember this is that yellow line on the previous chart falling because prices fall as yields rise. We've progressively stepped up that allocation and bought at higher and higher yields. And so you can see here we've gone from, this is what, 3 to 6 to 12. And then we had the big sell-off last year up to 4. And then we're like, okay, that's good. We've gone from 1 to 4. That starts to look attractive again. And we got up to about 20%. And look, it's sort of been around that level really ever since, and the yields have been consistent. The yields moved around a bit, but we've sort of been around those 4s. We're now at about 470, so there's a little bit, or 4.5, I should say. It's a little bit higher. And in the portfolios, we're about 19. So we've progressively added as we've got there, and then we sort of stuck with it. Now we're at a level where we think is, better value for the portfolios, and have avoided a lot of that, loss that we saw in the earlier chart. Middle East, I'm not sure how, I won't touch on it for too long. Obviously, the headlines and the humanitarian aspects have been terrible to see. But I think just worthwhile touching on, from a markets and a portfolio perspective, how we think about it and what matters from an investment perspective. It hasn't been the initial sell-off was about 5 or 6%, and then the market's kind of rallied back from there. The really key thing to watch in this instance was the oil price, which is this chart here. This is the move that happened when Russia invaded Ukraine. Like, the oil price went through the roof, as did a lot of commodity prices, given Russia and Ukraine's impact. But here, really, the oil prices, you had a very brief little spike, and then subsequently it's continued to fall, reflective of slowing global growth, not any concern for what's going on in the Middle East. Israel's not a producer, really, and so as long as the producing countries, the big ones in the Middle East, Saudi, Qatar, Iran, etc., are not brought into the conflict directly, there's obviously they're involved indirectly, but they're not, it's not directly impacting oil production. Then it's not really a markets issue. This is not, stoking inflation. This is not, hurting economic growth, I guess. And so at this stage, given the ongoing, I think the ceasefire's just been extended for another 2 days and a bunch more hostages released, which is great to see. So hopefully a negotiated, resolution is not too far away. And certainly all other big actors in the region, whether it's the US, Saudi Arabia, Iran, etc., have not come in directly involved in the conflict. They've all had plenty to say, but none of them have put troops on the ground in a meaningful way. And so that's a positive. It's obviously something we continue to monitor, and we're monitoring it more acutely, I guess, at the outbreak to see whether it was going to escalate, but nothing from a portfolio perspective that we need to worry about at this point in time.
Okay.
Valuation. So this is the good news. So yes, we've been on this volatile journey, but valuations are improving. Not necessarily outright cheap, but they're certainly improving. So the pink dot's the current forward PE of the market, the blue line's historical average. And outside of the US, Australia, emerging markets, Japan, UK, Europe, etc., all in line or below average. So they're starting to look much better value than they have done previously, and that's a good thing. So you're sort of not overpaying. The US is elevated, but again, that's really dominated by what's now been coined the Magnificent Seven. So Amazon, Facebook, Google, Microsoft, all the AI winning stocks. If we actually strip out the Mag 7, the PE of the market, the rest of the market, so the S&P 493, not the S&P 500, we actually get to about this number, their long-term average. And so even under the hood of the US market, there's been a lot of adjustment. Small caps are down 30%, a lot of the cyclicals and financials and all the other parts of the market outside of big tech have fallen a lot, and so that is from an active management perspective, but also from an opportunity standpoint, starting to give us comfort that we're maybe, it's been a long bumpy adjustment, but we're now sort of getting closer to seeing value emerging. Equities of, valuations have improved relative to bonds. They got really expensive relative to bonds. So we're looking at the yield from equities versus the yield from bonds. Obviously bond yields have sold off a lot. So that was a main driver of this relative move. But equally now that equities have fallen, at least outside of those big stocks, we're seeing relative value emerging across the board there as well. So whilst they're not cheap, they're not as, in relative terms, not as expensive, and certainly in absolute terms versus history now starting to look a lot better, and that's a plus.
Mm-hmm.
We spoke a little earlier, but defensive asset yields sort of paid to weight as a key theme, and this is really critical. We're overweight the blue part of the blue bars, which is corporate debt, or some people call this credit. Essentially, you are lending to high-grade blue chip corp companies in Australia. So think the big four banks and Woolworths and Telstra, BHP. So they've got an investment grade credit rating. All of these, we are not in the non-investment grade part of the market. That's risky at this point in time, slowing growth, etc. We're in the investment grade, high quality end. Investment grade means they don't default; they pay you back. And when you're lending to someone, as think of yourself as a bank, what do I get? I put my money in and I want my money back at the end. And then what return do I get for lending to them? So we only want certainty. We want investment grade. We want to get our money back for sure. And then it's about, well, what return are we generating for taking the risk of that? And at the moment now in these assets, it's 6.5% to 7%. We think that's pretty attractive versus cash at say 4.5%. Government bonds are kind of 4.7%. So you're getting paid a good sort of 2 and a bit% above cash for lending to really high grade blue chip companies. And we think that's a pretty healthy return given the backdrop. So as long as they're there to pay us back, which they will be, we're happy to sort of take that little bit of extra risk above cash now if these returns look attractive. And so you add that up. So that's the biggest overweight within the portfolios now, is actually owning, a substantial amount of these assets, because they're giving us, a lot of them pay monthly coupons. And so as the yields have reset higher, the other thing I should note is that these are floating rates, so a bit like your mortgage. And when the RBA put up rates, the yield on these goes up as well. And so that's really, helpful. So if there's another rate hike in February, you can add another 0.25 to that return in terms of the yield you're getting. So you're participating positively from higher rates through those assets. They pay monthly coupons, so as they reset, that monthly coupon should go up. So in theory, you're getting close to like 0.5% a month in income coming through some of these funds. And we think that that's a really attractive income stream, whilst we wait for growth to return on the growth, in the growth side of the portfolio, if that makes sense. And compared to where we were 2 years ago, for reference, obviously cash was 0. Government bonds we spoke about earlier were 1. They're now 4.7. And these were like 2.5. So we've come a long way in terms of the improvement in returns from the defensive part of the portfolio, which means returns and income from the portfolios going forward is much stronger than it has been for a long time.
So we're starting to capture these rate rises from an income point of view. Tom, what when you look at the defensive portion of the portfolio, and we'll use a balanced portfolio as an example, where let's say our neutral position is that 50% defensive assets. What expected when you add all this together with the allocations to each of these type of investments? What is the expected running yield on that part of the portfolio?
On the defensive side is now over 5% because of the blend of this. So which is really attractive. We'll talk a bit more about it. But you even look at the growth side, the Aussie equities are close to 6, fully franked. Infrastructure, which is a growth asset, which we talk about, which is overweight, it's 5.5. Listed properties 5. So even the yield on the defensive side as a result of values falling and churning, we've got higher yields from the growth assets and higher yields from the defensive assets, which is giving you, close to a 5%, yield across the portfolio. It's 4.5 to 5.
So the defensive portion, sorry?
4.5 to 5 is a pretty good place to start from a total return perspective.
So the defensive portion of the portfolio, for a change, is starting to do some of the heavy lifting as opposed to the market. Yeah.
It didn't do a lot for a long time. We were so reliant on getting growth. So this is a good thing.
Yep. Okay.
Just spoke about some real assets, infrastructure, listed property. Again, this is some great context. We haven't had a lot of exposure. We added to infrastructure this year. Real estate's pretty moderate, but we're thinking about adding more. But really, just for some context, this chart here on the right is showing the total return of equities versus versus infrastructure and listed property. And so since before COVID, basically, so the start of 2020, obviously you can see a big impact, big drawdown that a lot of these things experience as a result of policy. But if we go to, say, global equities, which had a big bull market after COVID 21, which we spoke about earlier, and really flat since then, but have got meaningful returns over the journey. Aussie equities, the green, is still above where it was, 20% higher. A lot of these others, if we look at ASX listed property, are sort of underwater from the start of 20. So they've had 4 years of doing nothing. And so if you think about that, the listed values, we can buy these today at the same value that they were before COVID. One of the key drivers of long-term inflation protection, but value really in real estate, is the replacement cost. It's a longer-term consideration, but think about the cost of building the office tower that I'm in right now, or you're in, Brendan, or the shopping centre. We all know firsthand what the inflation experience has been like over the last 4 years or 3 years in particular. Labour costs, material costs, building costs have all gone up dramatically. So replacement cost on these assets is anywhere from 20 to 50% above what it was 4 years ago, yet the price has basically done nothing. So that for us tells us that there's an opportunity. Now, in some office buildings that are of low standard as a result of work from home and all that sort of stuff are not where you want to be. But I know, like our building, for example, it's like, premium grade in the city, continues to fill up, like they refurbished it and a lot of new tenants are coming in all the time. And the rent, I can tell you, has not gone down in 40 years. In fact, it goes up every year. And so like that tells you, so you've got inflation sort of carrying your rents higher. Replacement cost of the building is probably more than what it's valued at right now. That's some good underpinning of long-term valuation. And when markets normalise, that's when you sort of get upside out of, making those types of investments. So if we look here, like the dividend yield on listed property in Australia was down at sort of under 3%, is now up at 6%. So we've seen a real improvement there. Now we need to be selective. Absolutely. There's certainly things have changed as a result of COVID and different policies. And we understand that. However, sometimes markets are good at this. They kind of throw the baby out with the bathwater and everything becomes on sale. And that's where the opportunity is to kind of start looking around. Infrastructure, similarly, a lot of these assets were caught up because of various policy standpoints. And also, in the short term, the market prices them on that bond yield that we spoke about earlier. So the sell-off in bonds has led to a sell-off in these assets in the short term. But again, that creates opportunities for us as long-term investors to go, well, if we think the sell-off in bonds is largely done, we know replacement costs have gone up, we can see that yields are more attractive and there's certain assets where rents have gone up and etc. But that's where we go, okay, cool, good time to start having a deeper look at this, adding to that to the portfolio, and then, we're getting paid to wait. So, 5 or 6% yield from attractive, well-priced long-term assets, the growth will come in time as the world recovers. And so if we talk about positioning, we're neutral on property now. We're looking at adding to that, and we're overweight in infrastructure similar to corporate debt. So assets that are now attractively priced in absolute terms and versus history, where we think a lot of the damage has been done, we're really starting to take advantage of that in the portfolio. So and that's really where we put what was a really big overweight position in cash is now starting to be deployed, which sets up the portfolio for the future.
Can you give an example of when we talk about infrastructure, Tom, as to any projects that we can identify that people can understand what an infrastructure investment looks like?
That little beep in your car when you drive all over Melbourne from your e-tag.
Yeah.
That's putting money in the coffers of Transurban. You know, that's a great example of a listed infrastructure stock. So the tunnel, the bridge, the roads to everywhere in Melbourne, all those e-tag beeps are going to Transurban. That's a good example. Other things are like gas pipelines, electricity transmission, airports, shares of Melbourne Airport, Sydney Airport, and the like. So they're all sort of potential types of infrastructure or critical assets, if you will, on infrastructure. So wind farms are becoming a bigger asset class when you fly. I notice now when you fly out of Melbourne, and you head north, but particularly when you head west, you can see all out over Western Victoria, like these huge wind farms now that just seem to go on and on and on. So they're absolutely investable, and you know, are held by the funds that we invest with.
Just got a question, an interesting one. Your understanding of the market to normalise when we've got this constant change. How do we explain, or what does a normal market look like when we've got such a volatile environment?
I think once we actually see that if inflation continues to fall and central banks can formally declare victory, that's going to be a real key point. And we're getting closer. It's just this last piece is dragging on a little bit. But certainly the trend is in our favour. It's going in the right direction. So we need to tick off that inflation's back to target and under control. And once we're there, that's going to then central banks can think about easing rates. So growth is slowing. Where economic growth is right now in Australia, even around the world, 5 or 6 years ago in the post-GFC environment where we didn't have inflation was never a problem. At the first sign of weakness in the economy, the banks would come in with stimulus and support the economy, and growth would get a kickstart. Right now, they're still hiking in Australia, or at least persisting with the existing policy. So we've got this weird situation where until inflation gets under control, we can't have the central bank stimulating growth. And so once that hits there, then it's like, okay, growth's slow. Let's cut rates a little bit. Let's try and get economic growth going. And that's really then you get that sort of cyclical recovery. We see economic growth re-accelerate, and then that drives higher earnings. And that's a normal cyclical upswing in markets. Right now, they're still trying to cool the economy, because that's what's cooling inflation. Yeah. But we look, the closer we get to that target, the closer we are to that inflection point. Appreciate it's just taken a little bit longer than everyone thought.
Yeah. Okay. Thanks, Tom.
Pleasure. I think, so from a presentation point of view, that's the end, Brendan. Sorry.
Oh, we're done? Yeah. Okay. I do have another question. We've been talking a lot about, and we're hearing a lot in the press about the likelihood of, I know we've spoken about this already in the past, the likelihood of a recession that seems to have the biggest impact on, at least from a growth perspective in the markets. What's the view at the moment?
We think that is likely over the next kind of 6 to 9 months. It's just that it's not a recession like a GFC that's really bad. I mean, it kind of feels not that different to what's going on out there in the real world right now, in terms of consumers are already spending a bit less, hiring slowed down. In fact, there's a few layoffs happening, a few redundancies. Unemployment's been ticking up slowly. It may just tick up a little bit more. And earnings have certainly struggled. Like the recent earnings season, we've seen, profits have been muted / down a bit. So it probably doesn't feel a hell of a lot different than this. The markets will churn a little bit around that. Maybe there's some further downside in certain parts of the market, and hence why we still remain underweight growth, because our view is still that recession is more than likely, given the amount of rate hikes that have come in, and the impact of that now just being felt by the economy. There is that sort of risk that we slow further / have a recession, but it's not like it's not really bad. And as I said, with inflation coming down and continuing to come down, that only helps that problem, and then that means the central banks can cut. So right at the point where the world's probably saying, "Oh, we're in recession," will probably be the inflection point for markets. So we'll be buying. Central banks will be cutting, and we'll be buying because a lot of that's already priced into lots of parts of the market, as we've shown earlier. They've already fallen a long way or not gone anywhere for 4 years. So we've had a lot of adjustment to asset prices, and what we're really looking for is just that inflection point where it's like, okay, market's accepted, we're in a mild recession, central banks are happy and they start cutting, and then that's really what gets you going on the other side. So it's now, yes, you might have the headlines, but it's probably from an investing point of view, it's not a bad thing here because that means we're at the end of this current cycle.
Gotcha. All right, Tom, I appreciate that. And as always, an in-depth analysis and where we're at and what we're doing and how we're positioning the portfolio, which is important to know. A couple of questions that I think we'll take offline that are a little more specific. And if there are any other questions from any of our clients, don't hesitate to let me know, and we can talk through those post this. But again, thanks, Tom, and thanks to all our clients. Appreciate you getting online and having a listen. Have a great day, and we'll be chatting again soon.
Sounds good. Thanks, Brendan. Thanks for everyone.
Tom. Take care. Bye, everyone.
Bye.
Bye for now.